I hope you had a decent experience with the first exam, and I hope that gave you an idea what the exams are going to look like from now until the end of the semester. I think for the most part, everyone did pretty well, and I don't know if it's the second attempt or the fact that you had plenty of time. I don't know what contributed to the successful completion of the test, but everyone, especially everyone on this call, did exceptionally well. So today we will continue with chapter 4. We'll talk about something a little different. So we're done with the basics in accounting. We know how to analyze transactions, how to journalize them, how to interpret the effect of transactions on the financial statements. So today, let me share my screen with you real quick, and let's open the PowerPoint presentation. So today we're gonna start digging a little deeper into some issues in accounting. So we'll be using everything that we have learned so far, but we will specifically focus on merchandising operations. So let's talk about what merchandising operations are first. So merchandising operations, hold on just a second. I don't think my PowerPoint presentation opened quite just yet. So we're all familiar with merchandising operations. These are companies that buy goods that they store, mark up, and later sell to their customers. So our goal today would be to learn to follow and understand the business cycle of a merchandising company. Then we'll talk about what inventories are, where inventories belong on the financial statements, why are inventories important for a merchandiser, and how inventories move through the business cycle of the company. We will learn for the first time what inventory systems are. So we'll talk about the perpetual inventory system as well as the periodic inventory system. And eventually, we will talk about a new way to prepare the income statement. And that new way is called the multiple step or the multi-step income statement. So what is a merchandiser? Earlier, I mentioned that we're all familiar with merchandising companies because we are surrounded by them. If a service company sells a service or they sell time to earn revenue, merchandising companies are quite different. So merchandising companies sell products to earn revenue. So the revenue reported by a merchandiser would be called sales revenue. There's a huge difference between reporting revenues for a service organization and reporting revenues and eventually income for a merchandiser. When we're working with the financial statements of a merchandising company, we will learn how to calculate net sales. So far, for the first 3 chapters included in our first exam, we called revenues service revenues, and we simply took revenues and subtracted expenses to calculate net income. Going forward, though, we'll learn that the first step in preparing an income statement for a merchandiser would be to figure out what their net sales are. Net sales are the gross sales of a merchandiser minus any sales returns, sales discounts, and sales allowances. In addition to that, the merchandiser will have to account for the cost of the goods sold. This is by far the biggest expense on the income statement of a merchandising company. The difference between net sales and cost of goods sold is what we call gross profit. Once we account for gross profit, or what is left from revenues after they cover the cost of goods sold, we list all the expenses, and that allows us to calculate net income. So on the bottom of this slide, you can already see the difference between Liberty Tax, which is a service company. As a service company, Liberty Tax sells us their time. So here we're simply taking revenues and subtracting expenses. When we compare the financial statements, especially the income statement of Liberty Tax to Nordstrom, you can see a substantial differences here. The company Nordstrom is a merchandising company. They start with net sales, which is their gross sales minus any returns, discounts, and allowances that are related to sales. They subtract the cost of goods sold, show gross profit or what's left from revenues after covering cost of goods sold, and then eventually they calculate net income. So in order for a merchandiser, this is slide 7.
Hey, I have a question. So those
Yes.
little red words said minus? Cause you.
Yeah.
Oh, okay. Thank you.
Yeah, that says minus. So in order for a merchandiser to show sales revenues, right, or sales, they have to purchase merchandise first. And we're all very familiar with that business model, right? In order for Walmart to sell us merchandise, in order for Amazon to sell us merchandise, they have to purchase inventory first. So this is their business cycle is pretty easy to follow, right? It starts up here where it says cash. They use cash to purchase merchandise inventory. This merchandise inventory is either stored in their warehouses or their stores. It's marked up. Eventually, it's sold to their customers. The customers give the company cash, and the company starts again using this cash to purchase inventory, to sell to their customer, to convert the inventory purchases into cash, and go on and on and on like that forever. We call that the operating cycle of a merchandiser. And from an accounting perspective, we will be very interested in accounting for the transactions that happen here, right, where the company uses cash to purchase inventory. So we know what that means. Inventory will be increasing or being debited, and then cash will be decreasing or being credited. Once the merchandise inventory is there and the company makes a credit sale, we'll be very interested from an accounting perspective to record the credit sale by accounting for the method of payment, in this case, accounts receivable, and the reduction in inventory. So this is what we'll be focusing on today. We need to understand what this inventory account is. So all merchandisers, unless they just started for business, they would have some inventory in their inventory account left from the previous period. To that beginning inventory, we will be adding their net purchases, the sum of beginning inventory net purchases, what we call merchandise available for sale. This is every single thing the company has to sell to their customers. Once some of the merchandise is sold, that part of the merchandise inventory account turns into cost of goods sold. And then we have the ending balance in the merchandise inventory, or what we have left at the end of the period. In chapter 5, we will be focusing on inventory specifically, and that's when we will learn how to work with the perpetual inventory system and the periodic inventory system. But for now, you need to know that every merchandiser needs to manage their inventories. A perpetual inventory system is something that we've all seen in the store. So when you go to the grocery store and the clerk scans whatever it is that you're buying, let's say that we're buying soda. So when we go through the cash register, the cashier scans the product that we're purchasing. A perpetual inventory system would update the accounting records as soon as the cashier scans the barcode. The cash register will show the sale, it will show the method of payment, and it will also show a reduction in inventory and an increase in cost of goods sold. So perpetual systems are very useful to a merchandiser because they give us real-time data, real-time information as to how much the sale was, how much the cost of goods sold was, by how much inventory decreased, and how the customer paid for that purchase. There's another inventory system. It's called the periodic system. The periodic system is a system which doesn't necessarily work for the big merchandisers that we will be talking about in this class. The periodic system updates the records for purchase and sale of inventory only at the end of the accounting period. So obviously, if the merchandiser is the size of Walmart or Home Depot or Lowe's or Kroger, they cannot wait until the end of the month to find what their sales and what their cost of goods sold is. But the periodic system is very helpful for taking physical inventory. So at the end of the period, every one of those merchandisers would go take a physical inventory and compare that to the perpetual systems records that they have. Again, next week, when we get to chapter 5, we will spend a lot more time discussing both the perpetual and the periodic inventory system. So let's look at the operating cycle of a merchandiser. We'll start with analyzing and recording transactions for merchandise purchases. Remember what we talked about a few minutes ago, a merchandiser would always start by procuring inventory and debiting it in their inventory account, physically storing it somewhere, whether that somewhere is the warehouse or the store, and then selling it to their customers. So we're on step 1, the merchandiser's purchase of inventory. So we'll look at the journal entries here in the PowerPoint presentation. As I announced on Blackboard earlier this morning, I will not have a live lecture on Wednesday, so I strongly recommend that you listen to the recorded lecture that's already posted on Blackboard. So today we'll just go over the theoretical part of chapter 4, just so you can get used to the terminology. So let's see what happens from an accounting perspective when a company purchases inventory for cash. So Z-Mart, they buy $500 worth of merchandise inventory. They pay cash. This is a pretty simple transaction that every single one of us can do. We will have to debit inventory by $500 and credit cash. So let's see what the question is here. So the question is, yes, the lecture for today will be posted, but there's also a lecture that's already posted in the chapter that covers the whole chapter. All right, so let's go back to the PowerPoint presentation. So again, when the company purchases inventory, remember merchandise inventory is a current asset account. So every time inventory increases, it will be debited. Now, one thing that I wanted to pay attention to is the title here. It says purchases without cash discounts. So what does that mean? If Z-Mart purchases $500 of merchandise inventory for cash, obviously they're not offered a cash discount. They're not offered any kind of discount from what we can see here. Discounts are offered for multiple reasons. The seller of inventory might offer a discount to the buyer of inventory if they purchase a lot of inventory. So we call that a quantity discount. There may be a discount offered if the buyer of inventory pays cash. We call that a cash discount. There may be a discount offered to a merchandiser that buys inventory on account, and the discount is offered for early payment. Whatever the discount is, it would reduce the amount the merchandiser finally pays. So let's see how the cash discounts work. So let's pretend that this is the same transaction. On November 2nd, Zmart purchased $500 of merchandise inventory, but this time they don't pay cash for their inventory. They pay on credit. If they pay on credit, the seller of inventory might want to encourage them to pay in cash faster, just so they don't have to wait too long for the cash collection to occur. So in this case, the text that I highlighted says this is a purchase on account. We know this is a credit purchase, and the credit terms are 2, 10, and 30. So let's talk about what that means. 210 simply means that if Zmart pays their supplier within 10 days, so this number here, 10, is the number of days in the discount period. If they pay within 10 days, they're entitled to a 2% discount. That's significant because if they pay within 10 days, look at the date of the transaction, November 2nd. If they pay by November 12th, then they're not going to pay the full $500. They'll pay $500 minus the 2% discount. So we're working with very small numbers here, but try to imagine how many inventory transactions does Walmart have every month? Or how many inventory transactions does Amazon have every month? So 2% discount in a high volume environment is huge. So I hope you understand what the numbers mean. So here, the company is offered 2% discount if they pay in 10 days. If they choose not to take advantage of the discount, they can pay the $500 in 30 days. So let's see what happens if they take the advantage of the discount or if they don't. Again, it's going to be very important for you in Chapter 4 to understand the terminology and the acronyms and the annotation. So here, the discount percent will be listed first. The number of days will be next. So you can see anything from 1% or 0.5% to 5% discount. And then this here could be anything from 5 days to 15 to 20. So discount percent first, number of days in the discount period, otherwise net all of it due in the days of the credit period. This here would be 30, 45, 60, 90, depending on the contractual agreement between the seller and the buyer of inventory. So should the merchandiser decide to take advantage of the discount, and should they pay in the discount period, as I mentioned earlier, they will only pay the amount they owe minus the discount. So in this case, let's go to slide 16. In this case, if Zmart pays within the discount period, which is 10 days, in other words, if they pay by November 12th, then they will only pay $490 because they're entitled to a discount of $10. So I want us to look at this journal entry here in the middle of the slide. Accounts payable will have to be debited. We'll have to zero that out because Zmart is fulfilling their obligation to their supplier. So accounts payable will be debited $500. Merchandise inventory will be credited and cash will be credited as well. So if we're looking in the P account, yes.
So merchandise inventory is like a current, that's a current asset, or what did you say it was?
Yes, merchandise inventory is a current asset.
Okay, thank you.
So whenever the merchandiser takes advantage of the discount of $10, you can see how, look at accounts payable first. If they satisfy the obligation to their supplier, then obviously they would owe their supplier $0. Now look at how we balance out the journal entry. the discount, which we call cash discount, is a credit to merchandise inventory. It doesn't reduce the amount of inventory. It reduces the value of inventory, because now the merchandiser really is paying $10 less for what they bought. The cash payment will also be a little less. So if you add cash and the discount, that should equal accounts payable. So is it good for companies to take advantage of those discounts? What do you guys think? Yeah, or less. Yeah, absolutely. It's always good to pay a little less, right? No matter how small the discount is, it's always a good idea to take advantage of it. So why would there be a reason for a company not to take advantage of a discount? What could be a reason for them not to do that? I mean, one of the obvious reasons probably is if they don't have cash to pay early. So, and I'm sure you would understand the reasoning behind it. If the company has enough cash to pay their employees, but they don't have enough cash to pay early and take advantage of the discount, obviously, or I would hope that they would pay their employees first before they take advantage of the discount. Another reason why a company might not take an advantage of a discount is if they have an opportunity to make more than the discount percentage. Let's say they have an investment opportunity where they would earn 6%, right? If the discount is only 2, then it doesn't make any sense to take advantage of the discount. It makes sense to invest and earn a little more. So if the company does not take advantage of the discount, then they'll just owe the full amount. And in our example here, it's $500. So again, discounts decrease the value of inventory. So let's see what else decreases the value of inventory. Merchandise returns and merchandise allowances. We call those purchase returns and purchase allowances. These are merchandise transactions that reduce the value of inventory. If the company decides to return goods to the seller of inventory, they obviously have to credit their inventory account. They have to decrease their inventory account. And then if there is a price reduction, that also decreases the value of inventory. So I want you guys to understand the difference between a purchase return and a purchase allowance. A purchase return is a physical return. So let's say I get something from Amazon and I physically package it up and send it back to Amazon. That's a purchase return. If something is wrong with my purchase, I don't want to return it, but I'm not happy with the price. I want to keep it, but not, because it's not what I expected or the quality is not what I wanted. Then Amazon might grant me a purchase allowance. They might give me a little bit of a price reduction. That would be an example of a purchase allowance. So purchase allowances do not involve a physical return. Okay. So let's see, what else do we need to know? If we have a purchase allowance, you can see how the amount of inventory will be reduced by that amount. So in this case, on November 5th, if they issue a $30 debit memorandum, this here becomes a purchase allowance. But look at purchase returns. Purchase returns are different. They involve an actual return, a physical return. So in that case, we will be decreasing inventory and accounts payable, and eventually we'll be looking for opportunities such as the purchase discounts. All right, whenever a merchandiser purchases inventory, they have to deliver that inventory to a location somehow. from an accounting perspective, we need to learn how to look at transportation costs, and we need to be able to determine how to account for transportation costs. The shipping terms determine at what point in time the ownership transfers from the buyer to the seller of inventory. So if the buyer pays for transportation costs will be debited or they'll be added to the cost of inventory. And if the seller pays for transportation costs, then the seller will be debiting an expense account on the income statement. That's a significant difference because, as you can see here, when the buyer debits the inventory account, the transportation cost increases that current asset on the balance sheet. But when the seller debits a delivery expense account, that cost increases an expense on the income statement. So this is the first step of that accounting cycle that we looked at the beginning of the lecture. We now know how to account for purchases of inventory. Eventually, though, the merchandiser would sell that inventory to their customers. So eventually, they would have to account for some sales transactions in addition to the purchase transactions that we just finished. So similarly to the purchase transactions, we'll look at sales transactions and the impact, the effect of those transactions on the financial statements of a merchandiser. So when the company sells merchandise, we need to account for two things. The first thing is we need to look at the revenue received. Whenever the company sells goods to their customers, they receive either cash or a promise that the customer will pay in the future. We call that promise account receivable. And the second journal entry that we have to recognize is the cost of merchandise sold to a customer. This is how much it costs the merchandiser to buy the inventory to begin with. We call that cost of goods sold. So remember, the sale of merchandise will always have two journal entries. One to show the sale, the second one to show the cost. So let's look at a sales transaction. So whenever Z-Mart sells merchandise on credit, you can see how there are two sides of the journal entry. The first one is to record the revenue, accounts receivable, and sales. The second one is to show how much it costs Z-Mart to purchase the inventory. That's the expense we call cost of goods sold. So these transactions will always go hand in hand. The company will always show the revenue and the expense together because of something that we learned in chapter 3. We learned the revenue recognition principle and the expense recognition or the matching principle there. Just like we had purchase discounts, here we have to account for sales discounts. So if the company offers sales discounts, then their sales will have to be decreased. And you can see in the middle here of the slide, sales discounts are debited. So I want to talk about sales discounts, sales returns, and sales allowances a little bit. We call those contra revenue accounts or contra sales accounts. Really, contra revenue is the better word to use. So contra revenue accounts, they're contra revenue accounts because they decrease sales. If the merchandiser offers a discount to their customers, sales will go down. If the customer returns merchandise to the merchandiser, sales will go down. So if discounts are offered, sales will be less. If sales returns and allowances are offered, or sales returns happen and allowances are offered, sales will go down as well. Again, sales returns, sales allowances, and sales discounts reduce the amount of sales that the company reports during the reporting period. One thing that we need to remember is that returns, this word sales returns, involve an actual physical return. So if a customer returns some inventory, then we will not only have to account for the reversal, the reduction in sales, we also have to account for the increase of inventory accompanied by that return. The merchandiser is receiving inventory back. Let me see if we have a question. I don't think so, but that beep, I don't know what that beep meant. All right, so let's look at.
Oh, that was I had raised my hand. So you said if the company offers us the sales discount, it like will decrease or increase?
Sales will decrease. So if I offer you a discount, if I say, hey, if you pay me back in 10 days, then for you, that's a good thing. For me, that's not a good thing because my sales will go down. Does that make sense?
Yeah, thank you.
So you always have to be mindful of who are you doing the accounting for, the seller of merchandise inventory or the buyer, right? So if I am the seller and I offer you guys a sales discount or a sales allowance, my sales are going to go down. For you, that's great news because you'll get to pay less. So when you look at the accounting cycle, here is what happens on the balance sheet. Merchandise inventory will be sold. Once merchandise inventory is sold, it goes on the income statement. So this slide right here, I find it a little confusing, but it breaks down the merchandising cost flow in the accounting cycle a little better. So adjusting entries for merchandisers are the same as anyone else. Will be closing cost of goods sold in addition to all the other temporary accounts, and the closing entries are the same as well. So let's go back. I'm going to close the PowerPoint, and I'll go back to McGraw-Hill. So I'll go to, I'm sorry, not the graded assignments. We'll just go to the McGraw-Hill Connect link. And let's look at the in-class practice problems. So I'll be looking for chapter 4. You know, these are not graded. These are just for additional practice for you guys. But if you like to work them, that's great. If you just like to watch me work them, that's fine too. So there is a few problems that I added here for you because I think it's a good practice for you to start understanding what inventory is, how does it fit on the financial statements, and how does it affect the balance sheet and the income statement. So in this case here, we're looking at merchandise accounts and merchandise computations. So if I look at what I'm required to do, I have to compute the cost of goods available for sale, the cost of goods sold, and the gross profit for the merchandiser. Let's look at what information I'm given. This is for the Kleiner Merchandising Company. They have accumulated depreciation, beginning inventory, ending, expenses, net purchases, net sales. They have all kinds of information, and some of it might be irrelevant. So in this case, I'm also given the information for Krug Service Company, and you can see how the service company differs. They don't have any kind of inventory on their balance sheet, and they don't have cost of goods sold on their income statement. So I'm interested in cost of goods available for sale for the merchandiser. I can only compute that for the merchandiser, which is this company, Kleiner, because the service company does not have inventory. So let's look at cost of goods available for sale. earlier in the PowerPoint presentation, we saw that the cost of goods available for sale is the cost of everything that the company has to sell to their customers. We start with the beginning balance of $5,000. And to that, we add the net purchases, not the net sales, but this $3,900 of net purchases. Just like what we're familiar with, supplies from the previous chapter. We have inventory available. We start with what came from the previous month, which is the beginning inventory balance, $5,000. And to that, we add the net purchases of $3,900. So the cost of goods available for sale would be $8,900. All right, so if I know that everything that the company had available for sale is $8,900 and they have left $1,700, so if I take $8,900 and subtract the $1,700 in their ending balance, I can tell you how much they sold. They sold $7,200, and I'm going to call that cost of goods sold. That's the credit to the inventory account. So cost of goods available for sale is a calculation you need to be familiar with, which is beginning balance plus net purchases. Cost of goods sold is another calculation you need to be familiar with, which is the cost of goods available for sale minus the ending balance. Now let's look at the third item here, gross profit. Gross profit, as defined by the PowerPoint presentation earlier, is net sales, which is $9,500, minus cost of goods sold of $7,200. So $2,300 is the gross profit. This is a calculation that the service company will not have. For the service company, I can only compute, when I look at this, I can only compute net income. So for the cart company, all I have to do is take the revenues of $14,000 and subtract the expenses of $12,500. So I know that their net income is $1,500. And the net income for the client or merchandising company, I know that their net sales are $9,500. So net sales, $9,500 minus the cost of goods sold of $7,200 minus all other expenses of $1,450 will give us, let's see what will give us, 2,300 minus 1,450, $850 would be the net income for this company. So these are the basic sales computations, the basic inventory computations for a merchandiser, and the basic net income computations for both a merchandiser and a service company. All right, so let's look at the next question. And let's look at purchase returns. I'm sorry, recording purchases, returns, and discounts. So these are purchase transactions. So when I prepare those, I know that these are journal entries and I need to go in chronological order because that determines if the company is eligible for a discount, whether or not they've taken the discount. So in this case, they sell 600 units times $10 per unit. And I'm sorry, I said sell, but they purchased $600 of unit of product at $10 per unit. So if the company is bringing in 600 units of product at that cost, then their inventory, which I'm going to call merchandise inventory, will be going up. Earlier, I said this is a current asset account. So $6,000 will be the increase. Merchandise inventory is a current asset account. We always increase it with a debit. And then I know that this is a credit purchase because of the terms of sale. This here tells me that the company hasn't paid cash. they've paid on accounts. So accounts payable is the correct amount here on the credit side. I'm going to go ahead and record the entry, and I'd like to check this entry before I move forward. My answer is not complete because I've only done the first entry, but my merchandise inventory and my accounts payable are now debited. Okay, so the next thing that I'm going to do on the 7th, they returned 25 defective units. So I'm looking at the 25 defective units on November 7th. So what I need to do here is, first of all, compute the value of the defective units. So if it's 25 defective units and they have a cost of 10 per unit, I am going to return $250. I'm going to have to return $250 in the second transaction. So on November 7th, if I'm having a physical return, I'm going to debit accounts payable $250, and I'm going to credit merchandise inventory because this is a physical return and the merchandise inventory has now left our possession. It's no longer ours. So this is a purchase return. So let's look what happens on November 7th, on November 15th, when they actually pay for the purchase that they made on November 5th. So there's several things to consider here. I'm going to go to the very first journal entry, which shows me that on November 5th, we increased merchandise inventory by $6,000. At the time, I can see that the company is entitled to a 2% discount if they pay within 10 days. I'm also going to consider what happened on November 7th. Remember how we owed $6,000, now we're returning $250. So after this return on November 7th, the company no longer owes $6,000, they owe $5,750. So now it's time to pay. Accounts payable. Okay, accounts payable will be debited $5,750. Merchandise inventory will be credited for the discount. The discount is 2%. So if I take 2% and multiply 5,750, I'll see that I need to credit merchandise inventory $115. And then the rest will be the cash payment, $750 minus 115. So $5,750 minus the discount of 115. The actual cash credit will be $5,635. So now I can see that the journal entry balances out and I can record it. Record. All right, does that make sense? Do you guys have any questions at all?
So can we go over like the math? I mean the math, or like how did you get like the numbers for all of them? Like starting at number 1?
For number one, I'm given these numbers. So I have 600 units of product that I'm buying at the cost of $10 per unit. So 600 times 10 is $6,000. So when the company is buying inventory, we're debiting merchandise inventory and we're crediting accounts payable because this is a credit sale. See right here, what I'm highlighting with my cursor says that the company has not paid cash, they've paid on account. Does that make sense?
Yes, and for the next one, because because they're connected, right?
Yeah, of course they're connected. So the first one is the purchase, the second one is the return. So see how I'm going to click on the first one again. They buy 600 units of product. In number 2, they return 25 units. Those 25 units are still $10 each. So $250 will be taken out of inventory. So remember, like we said earlier, inventory is a current asset. So if the company is returning product, they need to credit merchandise inventory. But if they credit merchandise inventory, accounts payable needs to be debited to show that we no longer owe the supplier $250. This up here is a liability. If we're showing a reduction of liability, we debit. If we're showing a reduction to an asset account, we credit. And then the last one, the accounts payable, because we started with $6,000 in accounts payable, then took away 250. So at the time of payment, the company owes 5,750. It's the difference between what they purchased and what they returned. The credit goes into merchandise inventory. This credit of $115 is the discount of 2%. So they're all related. This comes from the first transaction. And then the difference is the cash payment. I can't tell. Hey, Jacob, what's your question?
So I get how we get from step 1 to step 2.
Uh-huh.
We physically return products.
Yes.
So it seems like the merchandise inventory is directly related to a physical count, but then we credited the 115 because of the discount of cost. But it seems like the value is still it's a less the returns. So it seems like the value of the merchandise inventory is still 5,750.
But if you credit it, so okay, here I'm gonna type in the box here, so hopefully you can see it. So we start with $6,000 worth of inventory, right? Return 250. Do we agree with that? I don't know if you can see my screen, but 5,750 is what the value of inventory is. Does that make sense? So if we take advantage of the discount, so you still have the 5,750 in your inventory account, that value has to be reduced by the 115 because of the discount. So now the value, I'm not talking about the number of units in the inventory. The value of the inventory is 5,635 because of that credit, because of the reduction. Can you guys see what I typed over here? Does that make sense? Did you have any other questions about this? All right, thanks, Jacob. So this is kind of the logic of those discounts. It's not that we are getting rid of all of our inventory. It's that we're reducing the value because we were given a discount. And you'll see like the next problem. So these are sales transactions, for example. So we only have about 7 more minutes left, but I want to show you a sale of merchandise. So when we sell merchandise, so this is the opposite of purchase, right? In this case, the company is increasing account receivable because this is a sales on account of $3,000, and then sales are credited $3,000. So in this case, if I record the entry, here's my entry, they're all connected, right? Sales have gone up. At this point in the semester, you need to know that sales will always be credited if they go up. But if you look at the second, it says the cost of merchandise is $1,800. You cannot make the first journal entry unless you recognize the second, which is cost of goods sold, $1,800, and inventory, because we need to show that $1,800 worth of inventory is now gone. So all of these transactions are related, and you're going to have to do them step by step by step. So I recommend, if you guys have time, look at, like I said, I mean, the lecture is recorded. If you have time, go over that. Look at the practice problems, the in-class practice, because they're valuable for your homework problems. Anyway, that's, I think we're almost out of time. Do you have any questions? Anything that we need to talk about?